Well, as you know, today is the last day. Okay, I'm already sharing the app. So, and finally, right, we are, okay, what's going on here? Good evening. We can, as it has been already announced, right? It has already been announced that the final, right? The final has already started, right? You have 3 day window, which is until the end of this Wednesday. And we have actually a few. If you have been following the main lecture, we have already covered. If you have been following everything, we have already covered. But if you have been following main lecture, you have covered already everything. Topic 6 is the end of it. I mean, although we have topic 8, it's really an ambitious. It was an ambitious, really an ambitious attempt, because there's no way we can. I even mentioned here topic 7. That's for week 14 through 15. But that's actually week 14 plus. So that's practically extra topic that we could do if we have more than 15 weeks per semester. But anyway, so we are here, right? And I don't think okay. I don't think I can even finish, this topic today. But I'll give it a best shot. So in our last class, we were right before this, return on capital employed, right? So the point is, leverage improves earnings per share and return on equity, right? I've been telling you over and over, there's an optimal capital structure. An optimal capital structure is not zero leverage, but optimal capital structure is generally, I mean, if you're not using debt, you are basically, missing out on the opportunity to improve your return on equity and earnings per share. So we saw that example in the last class. We saw that example. Actually, 0% debt is not necessarily 0% debt is not necessarily a good thing, right? Because ROE is the lowest, return on equity is the lowest, and the earnings per share is also the lowest, right? But then, how far can we increase the leverage? How far? So if there's an optimal capital structure, and empirically, I've been telling you, empirically, what is the about 40 to 60, 30 to 40% debt, right? The leverage of the optimal leverage or optimal debt capital structure is 30 to 40% debt, which means 60 to 70% equity. But that's just empirical rule of thumb. So for each individual company, you have to look at ROCE. So what is ROC? It's return on capital employed. Return on capital employed. And you already know, basically, the measure of profitability is generally ROE. Remember that? Return on equity or return on total assets, right? These are, but they don't tell you how much return on equity or return on assets don't tell you how much leverage is beneficial, right? How much leverage is beneficial. So is this being, wow, what's going on? I don't like. Okay, this is being recorded, right? Session is being recorded. So okay, so unlike return on equity, return on assets, that return on total asset that don't tell you how much leverage can you can stretch to how much leverage, right? What is the limit? I mean, until when? How far can we increase our leverage? There is a point that you can stretch it to the maximum, and then beyond that, if you stretch more than that, then it's not beneficial to the ROE or EPS, right? What we know, we want to increase, we want to raise our return on equity. We want to raise also increase our earnings per share, right? So how do you calculate? It's simple. EBIT, right, times 1 minus tax rate over debt and equity. So that's total capital, right? Now, EBIT times 1 minus tax rate there's no name for that. I mean, if you think about it, it's the EBIT minus taxes, right? That's EBIT minus taxes. So whatever is left, there's no particular name for it. And for lack of better term, I said for lack of better term, because we don't have any better name for that, I'll just tentatively call it EBI, earnings before interest, right? But that's not a correct term because there's no such term. I'm just using it for lack of better term, right? But then think about it. This is the ratio between literal earnings before interest, right? Interest, why? Because interest is something that you have to pay out, isn't it right? Something that you have to pay out to the debt holders. But if you don't pay out to the debt holders, all of the earnings before interest is the cash flow to the firm if you don't pay out, right? Of course, tax, the reason we have to subtract taxes because there's no way you can avoid taxes. Because if you avoid taxes, then tax evasion, right? It's a crime. It's a felony. Tax evasion is a crime. So this gives you basically how much earnings, even including interest, right? Your capital is bringing in that ratio, right? That meaning of, then think about it. As long as this ratio is greater than, what is this? Adjusted cost of debt. Remember, there is a tax benefit from because interest is tax deductible, right? I mean, even though you're paying $10,000 interest, but because that much is subtracted from taxes, right? That small portion of that $10,000 the tax portion of $10,000 interest is kind of offset by that, lower taxes. Do you remember that, right? EBT is lowered by as much as taxes, right? I mean, EBIT, if there's no interest, the entire EBIT is taxed, right? But because there is interest, only EBT is taxed. So even if you're paying $10,000 interest, it is partially offset by, it's partially canceled by smaller taxes, right? So that's why effectively you're paying, if the tax rate, if your cost of debt or interest rate is 10%, and if the tax rate is 40%, right? You're effectively paying only 6% as taxes, 6% only as interest, right? So this is tax adjusted cost of debt. So think about it. By adding more and more debt, right? By adding more and more debt, of course, as long as this ROCE is greater than cost of debt, right? There is benefit, still benefit to be gained from leverage, right? Makes sense? There's still juice you can squeeze out of it. There's still juice you can squeeze from it. Until when? Until they become the same. Until they become equal. Once cost of debt, ROC is equal to cost of debt, there's no more benefit, right? Now, by adding more debt, still, if ROC is still greater than cost of debt, yeah, there's still there's still more juice to extract from it, right? But once they become the same, there's no more juice to extract from it. So until, as long as ROC is greater than the cost of debt, you can still increase leverage. However, once they become equal, no. And then once ROCE is less than, of course, more leverage is bad, right? Bad for your financial health. So here's a next example, but the next example explains it better. So let's take a look at this. Managing through financial leverage. Selected financial info for Albany Corporation is as follows. I think Albany Corporation was in our example before that, they have $10 million in debt. $10 million. And all these figures are in thousands, right? Everything is in thousands, except for number of shares, right? This is raw number, right? Raw. I don't need to write that. Only this is, otherwise everything is, in thousand. So it's in two sections, right? This part is what? Income statement. Isn't that right? And this section is balance sheet. Right? That's balance sheet part. So now if we work out these numbers, and it's not a difficult thing, interest, so let's do this. If you downloaded this file before, right? It's nothing new. Go to ROCE, bottom tab ROCE. don't, I'm sure you shouldn't ask, Professor, where is that? Where is that file? It's, always, we have this, we've been using this file, Excel file, right? How come I have two folders? So, this is this, that example. This, their EBIT is this, and their interest must be 12% of this, right? No, not 12% of that, but 12% of debt, right? Interest is what you pay on your debt. So F3 times 12%. That's your debt. EBIT, no, this is not something. You should subtract it. Don't get misled by this red font. Red font is normally, negative, right? Red font is normally negative, but here it just gave. It's not negative number. It's just it gave negative font. If it is really negative, if you sum it, it will be automatically deducted, right? It will be subtracted automatically. But the formula in there was not subtraction. It was auto sum. And then it really added up. So that means the red font was just accidentally put in there, right? It doesn't mean really negative. So that would be EBIT. And then tax rate is 40%. Yeah, well, just 40%. Then EAT will be this minus this, right? Okay, and their debt is like 10 million, equity 90 million, capital, so total capital 100 million, number of shares 9 million, and this is actually book value per share. Actually, if you think about it, it's book value per share. Book value per share is it my voice? Book value per share. So, book value per share is equity. That once again, don't forget everything is in thousands, so I'll have to multiply it by 1,000 and divide by number of shares. They should be $10, right? And then return on equity. Return on equity is EAT over equity, 15%. So far, everyone is okay with that. No difficulty following. Earnings per share. Our EAT. Now, this time we'll have to, again, multiply it by 1,000 because everything is in thousands. And then, oops, what happened? And then we divide it by number of shares. Earnings per share is $1.50. Okay, I think you guys are. There's no movement, so just okay. Now some vital sign, right? There's no like signal of any living being. Okay, and so here's so let's check the basic data. So yeah, interest at 12, of course, 1.2 million, right? EBIT 22.5 million, right? Tax 9 million, EAT 13.5 million, book value per share $10, ROE 15%, earnings per share $1.50. So far, yeah, basic facts check out. And now from here on is the question. The question is, the treasurer feels debt can be traded for equity without immediately affecting the price of the stock or the rate at which the firm can borrow. What does this mean? The treasurer feels debt can be traded for equity. What does that mean? They want to rearrange or rebalance their capital structure. But doing that, they are not going to bring in any more paid-in capital, but they will simply want to restructure their leverage, capital structure. So trading debt for equity means, so they will borrow money, and with that money, they will buy back their shares. And then that way, total capital will remain the same, but the capital structure will change, right? There will be more leverage and less equity, right? But why do they do that? Because you remember that as long as ROCE is greater than cost of debt, right? There will be, it will increase ROE and it will increase earnings per share, right? So, because they are not at optimal capital structure, they want to bring it to optimal capital structure, right? And then the target, okay, so that means, buy back, borrow, sell bonds. What that means is, again, sell bonds, and with that money, buy back, stock buyback, right? Buy back stocks, their own stocks. And think about it, when the number of shares outstanding goes down, if they buy back, number of shares outstanding will go down. And if number of shares outstanding goes down, earnings per share will have to go up, right? Earnings per share will have to go up. Price per share will have to go up. Price per share will have to go up, right? So management believes it's in the best interest of its stockholders to move the firm's earnings per share from its current level up to $2 per share. Yeah. So this is the new earnings per share. So, however, no opportunities are available to increase EBIT above the current level. Yeah, because EBIT depends mostly on total asset size, right? So if the total asset size remains the same, there won't be any change to the EBIT. So will borrowing more money from retiring stock raise Albany's earnings per share? And if so, what capital structure will achieve earnings per share of $2? So in other words, how much can they borrow? What will be the new level of debt? What will be the new level of debt, right? That will achieve this target earnings per share of $2. So here, there's some verbiage, but since we've done it already on Excel, let's do. So you know what earnings per share is, right? You can okay. See, earnings per share is basically EAT. Earnings per share is basically EAT divided by, earnings per share is EAT over total capital, right? I mean, EAT, what am I, EAT over equity, because this is what? If you subtract debt from capital, total capital, that's equity. Isn't that right? Equity only. And EAT is basically EBIT. This is EAT. EBIT minus interest. This is interest. Isn't that right? Cost of debt times the amount of debt, right? That's interest. So if you subtract interest from EBIT, right? That's EBT. That's going to be EBT. And then times 1 minus tax rate will give you EAT. EBT times 1 minus tax rate will give you EAT. So this whole thing is EAT. Think about it. EAT over equity, that's exactly earning. And then EAT over equity, that's that's ROE. That's EAT over equity is ROE. ROE times book value per share. That's earnings per share, right? That's the definition, right? ROE times book value per share, right? Return on equity times book value per share will give you earnings per share. That's the definition of earnings per share. Now, just to revisit, right? ROE is EAT divided by equity. Earnings per share is ROE, return on equity times book value per share, right? Book value per share is the share price. Share price times return on equity, right? Return on equity is the percentage, return in percentage, right? So stock price times return on percentage will have to give you earnings per share, right? So so that's the way you can find earnings per share. And then if we can solve this equation for D. It takes a lot of, I didn't show you steps of derivation, but not here, but somewhere I believe I put it somewhere. I don't know where I put it, but I put it somewhere. Steps of, not here. But but through if you rearrange all this and solve for D, then you can solve, right? You can solve this equation for D. D is the debt level, right? The amount of debt, right? So if you plug in new earnings per share there, it will give you new debt level. So it looks quite complicated, but all we need to do is just, and I've derived this myself. And I've checked it, and it's been it's an impeccable formula. So somehow, what was very disappointing to me was that here this is what actually the book gave, using trial and error method, right? We can determine that 45 million is the approximate amount of debt that makes earnings per share equal to 2. That was very disappointing to me. The book is telling you to use trial and error method. So I personally derived, right, from, based on, so this is my original, right? A lot of things that I teach is my original material. This is my original material. You can find, okay, this is book value per share, right? From this, you solve it for debt backward, right? And then, because new earnings per share is given as $2, if you solve it backward, right? And that formula is here, right? For D, you can find new debt level given new earnings, the target earnings per share. So this is my original. A lot of, as I said, a lot of things I teach is my original. Of course. So then we do exactly like that. New earnings per share. So I'm going to put everything in the big parentheses. Earnings per share times total capital, right? Minus 1 minus tax rate, okay? Times book value per share, right? Times EBIT, close parenthesis, over, open parenthesis again, earnings per share, new earnings per share, minus 1 minus tax rate, actually I have been, not giving much thought about it, but, I should actually talk to the publisher about this formula, because the book never gave. Why? Use trial and error? That is not so. Times, cost of debt here, times book value per share. Okay, close parenthesis, hit enter. Oops. And why is it in? Something's not right. Let me C12. Earnings per share new times K F5. What's the formula? F5, right. Minus 1 minus tax rate there, B6, times book value per share, C9, times EBIT, C3, earnings per share, new, C12, minus 1 minus tax rate, B6, times, B is not B6, cost of debt here, times C9, book value per share, C9. There you go. 45 million. Not approximately, but 45,156,000, right? 250. That's the exact new debt level, right? That will give you exactly $2 earnings per share. That's the new target, right? $2. That's the new target earnings per share. And you can increase that to this level, right? And that level will give you exactly this earnings per share, right? So this is how I did it, and it's just math, And if I could derive this formula myself, then the author of that book, what was his name? The book. Who's the author of our textbook? This is ridiculous. I mean, our book, name of our book is course information, syllabus. William Lasher. William Lasher, this guy could have done that too. I don't know why. I mean, I haven't looked up his, credentials. He must also have a PhD in, to write a book, in corporate, a textbook in finance. He must have a PhD, and if he has a PhD, like economics or finance or financial economics, then he should be capable of deriving that formula himself. Why, but a lot of things in the approximate, right? And still, a couple of more questions to answer. What is the ROCE? Of course, ROCE, we know the formula. ROCE is EBIT times run minus tax rate over total capital. So ROC is 14.22, and our adjusted cost of debt is interest rate times 1 minus tax rate. It should be 7.2%. So ROCE is almost twice the cost of debt. So that means you have a lot of room to increase leverage, right? You have a lot of room to increase leverage. That means there is a lot more juice to squeeze, right? From that whatever orange or okay. So everyone is okay with this? Now, there is not only financial leverage, there is operating leverage as well, but we're still talking about financial leverage. Financial leverage is a two-edged sword. Yeah, it's just like, I don't know if you've ever heard of, margin account. If your margin account is what? And margin account is very, when you're investing, borrowing money. You borrow money to, there are ETFs or ETNs that triple leverage, ETN or ETF. What does that mean? They borrow the money, right? It's an ETF, and they borrow the money. They borrowed money to the three times the equity level. And then, of course, then if the market is good, it will multiply your result, right? Threefold. But if the market is bad, it will crash like, jumping from the plane. I mean, even without adding any weight, if you jump from the plane, you will fall at the speed of the natural acceleration rate of the gravity, right? But if you add more weight, let's say, put if you added more weight by using some lead or sandbags around your, right? If you're working out to strengthen your muscle, when you run, you have this lead belt. You put the lead belt around your ankle or wherever. So you put lead is the heaviest, the densest material I don't know if it is the densest, but it's very heavy. You run, that adds, obviously more stress to your muscles, right? So it will build your muscle faster or something. But suppose you're jumping from the plane with more weights on you, right? You fall very fast, right? Unless, until unless you pull the parachute, right? Deploy the parachute in time, you'll probably you will need a bigger parachute, right, to land safely. But leverage is like that. It multiplies good result into great result, but it also multiplies the bad result into terrible results. So it's a two-edged sword. It increases the volatility. Um, so leverage adds volatility to financial performance when operating results change. Effects push stock prices in opposite directions. That goes without saying. So column 1. You remember this? Leverage scenarios, this is table 14.1, right? And then table 14.2 is the bad case scenario. Bad case scenario. And then column 1 is no debt. And with 80% debt, ROE was 12% with zero debt, but 80%, 36% with 80% debt. But in the bad case scenario, 0% ROE with 80% debt, 4.8% with 0%. So in other words, comparing good scenario and bad scenario, right? Good times table, no debt case, 12 but 80% debt, 36. So in bad times, and the difference between good times and bad times is only 7.2%, right? In case of no debt, but in case of this 80% leverage, the difference between the good time and bad time is 36%. So more volatility, right? Quite volatile, right? An incremental difference in the return on equity due to financial leverage is 28%, 29%. So obviously at low debt levels, there is a room for increase in leverage, and increase in leverage has a positive effect on investors. So in other words, as long as ROC, as long as ROCE is greater than cost of debt, they will increase. But and the risk effect is less obvious. I mean, they turn the blind eye on the risk, increasing risk, because you are still far away from this point. You're still far away from this point. But high debt levels, and of course, risk concerns outweigh the benefits. So, and adding more leverage, additional leverage, will only lower the stock price. So, as leverage increases from zero to high levels, okay, this graph, right? So as leverage increases, right, from zero, stock price goes up, right? And then there's an optimal capital structure where stock price is maxed out, right? And this happens usually, so empirically it's between 30 to 40% debt, right? 30 to 40% leverage, but it's, you cannot, it depends on the companies, each company's, uh, different, financial profile. But, how do we nail? Is there a way we can nail exact? Is it going to be 35%? Is it going to be, 32%? I mean, how do we nail the exact percentage? There's a way to do that. There's a way you can, and past that optimal capital structure, past that, then, the more you increase the leverage, then stock price will go down. The book says, there is no exact way, but, actually there is exact way. So first, we already know, conventional wisdom. A firm with good profit prospects and little or no debt is probably missing an opportunity by not using borrowed money if interest rates are reasonable. Yeah, think about it. Now, for the last decade, almost, more than, 10 years, since 2008 financial crisis, right? Interest rate, and until even last year, interest rate has been very low, right? Fed funds rate was, 0 to 0.25%, and generally interest rates were. So if the interest rates are low, borrowing money is very cheap, and it's not a very, smart thing not to borrow money, not to increase leverage, right? If because you're not taking advantage of. For most businesses, however, the optimal capital structure is somewhere between 30 and 50% debt. I should say, 30 to 40%. And the debt level greater than 60% create excessive risk and should be avoided, because financial distress it's going to be very significant. Now, so this is something, firm's target capital structure is management's estimate for the optimal per return on capital employed analysis. New debt level can be solved as follows. New debt level can be solved as follows. However, the change in leverage involving equity purchase. Now, we are assuming that two things. When we trade debt for equity, meaning, borrow money and buy back stocks, we're assuming two things. Cost of debt remains the same, right? And stocks can be purchased at book value. We're assuming two things. Most of the times, cost of debt, think about it, the more you borrow, cost of debt will have to increase, right? As the level of debt increases, right? The level of debt increasing means, the risk is increasing. Default risk will be increasing. So, therefore, borrowing cost will have to go up, right? When you go to the bank to borrow money, of course, it's going to be not easy to. It's not going to be that. But with the, it's not. I can tell you, it's not easy to borrow money. But if there is a collateral, not a problem. If there is a collateral, but still, the bank will. So usually, getting a mortgage, not a problem, because unless you have really terrible credit score, but if you have generally okay credit score, you'll get the loan. Why? Because the house becomes the collateral, right? The property becomes the collateral. And the thing is, but they will also check if you have existing debt. If you already have existing debt, the chances of your loan approval will go down. Why? Because You already have debt. You're getting more debt. The debt level goes up. Your default risk goes up. The lender will be reluctant, right? So they will ask for higher interest, right? Obviously, so cost of debt will have to go up. That's natural. So we are making, as I said, we made two assumptions here. First of all, cost of debt is constant. I mean, even if you increase the leverage, you can still borrow at the same cost of debt. But that assumption is not very realistic, right? That's very, ideal assumption. I mean, if the incremental leverage is not very much, then yeah, you may still borrow at the same rate. And the second assumption, you can buy back at the book value. You can buy back stocks at book value. However, if the usually market price will be greater than book value. I mean, if it is a company that is well perceived by the market, their market price would always be greater than book value. So if you cannot buy back at book value, this will be a little, that means you'll have to pay more. I mean, you'll have to pay more than the book value. So, so if you are not purchasing at book value, it's more complex. Repurchase stocks at non-book value, same general impact on ROE, but not necessarily for earnings per share. Right? Because, okay. So, degree of financial leverage, that brings us to the degree of financial leverage. Degree of financial leverage is sort of like a way of measuring the range or the range of volatility when you use when you increase leverage. So financial leverage magnifies change in EBIT into larger change in ROE and earnings per share. That's something we have seen so far, right? If you increase leverage in the good times, first it will change earnings EBIT first, and eventually it will increase return on equity and earnings per share. But that's in the good times. In the bad times, it's a double-edged sword, because it magnifies good results into greater results, and in bad times it magnifies bad results into terrible results. So, degree of financial leverage quantifies the effectiveness of leverage by relating a relative change to earnings per share and EBIT. Yeah. So there are two formulas for degree of financial leverage. One is EBIT over EBIT minus interest. So in other words, what is this? This is the ratio between EBIT and EBT. Right? So think about it. If interest is a lot, if this ratio is 1, what does that mean? If this ratio is 1, the company has no leverage. If this ratio is 1, the company has no leverage because no interest is being paid, right? But if this ratio is very huge, big, then company is using a lot of leverage and therefore paying a lot of interest, right? That is the only factor that explains this. Another way of measuring degree of financial leverage is percentage change in earnings per share and percentage change in EBIT. So in other words, when EBIT changes by something, right? When EBIT goes up by 30%, how much does the EPS goes up? if earnings per share goes up by 60%, wow, that degree of leverage is 2. Financial leverage is 2. In other words, but when that means when it goes down by 30%, when EBIT goes by down 30%, EPS will go down by 60% as well. So we are out of time. I mean, there is this example, but I don't think we can do it today. But if we can't do it today, but it was already done by main lecture, right? It was already done by main lecture. So I want you to go over. I mean, you can find my main lecture in the in my YouTube channel. So please, do it at your own time. So this has been okay. So this has been the this course, corporate finance, right? And I hope you have enjoyed this class. And I don't know if that's enjoyable is a thing for this course, but hope to see you again. If you have to take, if you still have to take Finance 300, hope to see you next semester. All right, so take care, everyone. Good luck with your with your final, and have a great summer. Okay. All right. Take care, everyone. Take care. So I'll stop recording.